Okay, so here we go, guys. We're going to cover Chapter 4 today. Chapter 4 covers mutual funds and other investment companies. Um, I'm probably going to do like 2 or 3 different videos. Each video is going to be about 10 to 15 minutes long. We're going to talk about mutual funds. So what is a mutual fund? And I have my textbook right here, guys, and then I'm going to be, going to the screen for some shots, some screenshots from the computer and so on. But what is a mutual fund? Okay, that is like the question of this chapter. What is a mutual fund, and then what types of mutual funds are there? I think we're very familiar with the idea of investing in a single stock like Apple or General Motors and so on. And I think we're very comfortable in understanding this type of investment. But mutual funds, sometimes we have a little bit more of a hard time understanding what they are. A mutual fund is basically a collection of investments. Okay, so for example, let's say you're a medical doctor or a lawyer. You have some money, you don't know what to do with it. What you can do is you can give your money to a mutual fund, right? Let's say you give the mutual fund $1 million. Then the mutual fund, which is the third party, will grab that $1 million and then will turn around and invest it in the market in different assets. Okay, so he'll grab the mutual fund will grab that $1 million and then maybe put $200,000 in one stock, maybe $100,000 in bonds, and then maybe $700,000 in other stuff. Okay, so basically what the mutual fund does is grab the $1 million and then put it into different investments. Okay, they can either be different stocks or there can be different asset classes like bonds and so on. And the mutual fund does this not just for one person, but they do it for many individuals. So you can think of a situation where there's 10 different medical doctors, each one having $1 million. The mutual fund collecting $1 million from each one of the medical doctors and then turning around and grabbing that money and investing it in the market, either in the stock market, the bonds market, or some other type of market. So the mutual fund basically acts as an intermediary between the market and the medical doctors. And the money, the $10 million, gets pooled, right? It gets all put together into the mutual fund, and the mutual fund turns around and invests it for the doctors. And then, they provide reports on, how much they made this year. Also, the mutual fund's going to do this for a cost, right? So they might charge 1 to 2 percentage points per year just for fees and so on. So basically, this is the way it works. Now, what are some of the advantages of a mutual fund? Some of the advantages include diversification. So if you think of the medical doctor grabbed his $1 million, gave it to the mutual fund, and then the mutual fund invested it in different assets or different securities across different asset classes. So this creates some kind of automatic diversification for the doctor. So the doctor doesn't have to decide, how much he's going to put in one asset, how much he's going to put in another security, and so on. The mutual fund manager does that for the doctor. So in that sense, mutual funds help with diversification. Another advantage of the mutual fund is professional management. The medical doctor might not know much about investing. He knows a lot about his field, medicine, and so on, but he doesn't really know about investing. So he gives his money to the mutual fund, and then the mutual fund has a manager or a portfolio manager that makes these decisions, makes the best decisions according to his information on where to put the money and how to put in what proportion and so on. So professional management is also one of the major benefits of mutual funds. And then another example or another advantage of a mutual fund is that the minimum investments are quite low. So some mutual funds, require $2,500. Others require a minimum investment of $1,000, and then others require maybe a minimum investment of $250. So the initial investments in mutual funds are quite low. It's quite easy to get into mutual funds. So literally there's thousands of different types of mutual funds, guys. It's hard to describe all of them, and we don't have time to talk about all of them. But there are some drawbacks to mutual funds. One of the drawbacks are the costs or the fees associated, these annual fees that the mutual fund will charge its customers for managing their money. This is one major drawback. There's also what they call open-ended mutual funds versus closed-end mutual funds. Open-ended mutual funds actually allow you to, they expand their amount of shares that they have versus a closed-end fund where the shares are actually fixed and there's no extra shares being issued. So if you look at figure 4.1 on page 105, you'll see that you have investment companies at the top, right? So these are like the mutual funds. The investment company is the mutual fund. And you have open-end funds on the left-hand side, and then you have on the right-hand side closed-end funds. Open-end funds are more common, and open-end funds actually get split into money market funds in this figure. Money market funds are short-term funds. So these are mutual funds that deal only with short-term investments. So the mutual fund grabs investors' money and invests it in the market, but only in short-term, instruments or assets. Typically less than a year. So maybe like treasury bills, 3-month treasury bills, or maybe some commercial paper. Commercial paper being, loans from companies that are short-term and so on. And then you have the long-term funds. Long-term funds are basically more than a year, and they invest in longer-term assets. So they might invest in, General Motors, or they might invest in a 10-year, bond and stuff like that. So these are long-term investments. Within long-term funds, you have stock funds. So mutual funds that only or most of their money is invested in stocks. Okay. So they'll invest, 80-90% of their money in stocks. Or you have bond funds where they invest most of their money in bonds. Okay. And then you have what they call blended funds. And blended funds, it's a mixed, right? So maybe this mix might be 30% bonds and then 70% stocks, so it's more of a mix. Now, of course, it depends on what the investor wants, right? If you want higher risk, then you're probably going to end up investing in stock funds. And you might end up investing in smaller stock funds, right? Meaning mutual funds that invest their money in stocks that are smaller market capitalization. If you want less risk, then you might end up investing in bond funds, right? And maybe some bond funds that provide, more income. So we talked a little bit about fees, mutual fund costs and fees. There's different types of fees associated with funds. Some funds have what they call front-end fees or front-load fees, meaning that they charge their commission at the beginning when you invest. Others have back-end fees or what they call their backload fees, meaning that you sell your position and then they'll charge you a fee at the end. So front-end load and so on. Funds also have what they call 12B1 fees, and they also have trading costs, and they also have management fees. And you can go ahead and take a look at them, at all these different fees. I'm not going to go over all of them exactly. So let's see. let me go ahead and show you some of the different funds out there. I think this one is pretty interesting. You're gonna find it very interesting. Let me see if I can get to the website here. Okay, so here we go. Let me position this somewhere. Let's look at what they call the Vice Fund. Okay, this is a very interesting fund. It's called the Vice Fund. So this is a mutual fund. The provider of this fund is USA Mutuals. And then, you can go look at summaries of these different funds that they have, these different Vice funds. So this is the Vice Fund. The Vice Fund invests in companies, both domestic and foreign, within industries that have significant barriers to entry. The fund seeks to select well-performing stocks of alcohol, tobacco, gaming, and weapons and defense companies because it believes these industries tend to thrive regardless of the economy as a whole. So basically, the Vice Fund invests in gambling, tobacco, alcohol, and the defense industry. So these Vice type of industries. So that's the main focus of the fund. Look at the minimum investment. This one has a $2,000 minimum investment, and then you need to add at least $100 if you want to put more money into the fund. And then it has like different types of investor classes. Okay. Here it gives you some literature. Okay. This is the fact sheet, right, for the Vice Fund. So you can click on the fact sheet on the Vice Fund. And look, it has a tobacco, defense and gambling and alcohol and all that. Its overall Morningstar rating is 3-star. Morningstar is a big provider of mutual fund data and so on. They're very, very important. And then this is the ticker symbol for the Vice Fund. It's VICEX. You can see it right here on the left-hand side. And then it gives you the investment objective. The investment objective of the Vice Fund is long-term growth of capital. Okay, so they want your capital to grow. Okay, basically capital gains. Okay, and not so much income, but capital gains. And then they give you a summary here of the performance of the Vice Fund against the S&P 500 and against a large blend category from Morningstar. And the green line basically is the Vice Fund since 2002 all the way to 2016. Basically, the Vice Fund has outperformed the S&P 500 over this 14-15 year period. If you would have invested $10,000 in the fund back in 2002, today you would have roughly $36,000. Okay, not bad for 16, 17 years. It also talks about the management philosophy. It talks about the investment strategy. You can take a look at that. Gives you the average annualized total return performance since inception and then for various years. And then it gives you the portfolio summary. If you look at the portfolio summary, they have equities of 96%. So this is pretty much a stock fund, right? And then they have cash and cash equivalents, like short-term securities. So this is a stock fund. And then it also gives you the, their main investments, their top 10 investments. Altria Group is one of their main investments, Reynolds, MGM, all these different Vice companies, Raytheon, the defense industry, and so on. So we're running out of time here with the 15 minutes. Let me go ahead and stop here, and then we'll continue on to the second part of this chapter.